Oops, Doc here from North America. Good morning, good afternoon, and good evening. I thought I was on. I thought I was on for the last minute and a half. Sorry about that. Here we go. So let's see what's on the chat line. I didn't get to the chat line yet, so I can't even see if anybody said, Doc, we don't hear you. Can you hear me now? Let's lower this volume a little bit more than that even now. I was just rambling along about yesterday's action. Everybody gets so disrupted and acts like as if the market's come to an end just because the Dow dropped below one of the lowest points in a year. Here we are, a couple hundred points higher. Percentage-wise, it is amazing. I myself at least look at it and I go, wait a second, is that broadcasting? Wait a minute. I don't even think we're on. Are we on? Let's double check that. I still don't hear me. There it is. Sorry about that, traders. There we go. Now we're on the chat line. All right. So again, as I was saying, they are so hyperbole at this point. Hello, hello. Who's that? That's Serge. Serge, how you doing this morning? Sergius. How's that? That's close enough, yeah? We're doing good. Serge, cool. Yeah, so they're so upset all the time. They're always nervous. I mean, it's like they're a cheering section when it comes to the financial news. That's what they do. They just cheer. Well, that's good. It seems like a nice day here. It's what is it? It's 7:34 a.m. here in the morning. So we're just kind of starting our day. I've been up for a couple hours checking out the markets. How about yourself? Where are you located? Are you in, I can't even tell, maybe Eastern Europe? Maybe out that way somewhere? Or could it be even out towards Greece? Something like that, out towards Greece? Latvia, great. Cool, that's even better. It's even better. You're in our hometown. That's the way I always look at it. When I hear the word Latvia, the moment I think of reggae, the local. Hey, that's cool. That is very cool. Yeah, I'm kind of confused anymore about the financial news the way we see it. I mean, you can see the dollar index there. It's at 104.80. They're starting to wake up to the fact again. They're waking up to the fact that they're not going to do 7 interest rate cuts. They're not doing 6 interest rate cuts. They'll be lucky if they can get away with 1 interest rate cut, and even then, it's hard to say. We got another person on here this morning. Very good. Morning to you. No chasers. I like that. We'll just call you No. I like that. Or maybe NC. I like that. Chazers? Yeah, so I mean the financial media, you listen to Bloomberg, you listen to CNBC, you listen to Reuters, you listen to BBC, AP. None of them make any sense anymore. It's like I'm out here in the wilderness. There's very few news sources I can follow that I trust. After 50 years of trading, it's really sad. And all they are is a cheering section. It's like having a stadium set up. It's like a sporting event when, people are trying to basically invest their money so it will grow. The whole financial industry, ever since quantitative easing and Mr. Obama in 2008, Barney Frank in the House, basically allowing people to borrow double and triple on equity guaranteed by the government. Yeah, don't chase the markets. I like that. That we could have a whole conversation about that. Don't chase the markets is so true. It is so true. Don't chase the markets are very important. What you try to do is you try to logically invest in things that have abilities to grow, that are not overpriced, that are not. I mean, you can fad trade. I guess you could call it that. I mean, look at the way the chips are. They're trading at 120%, like Nevada and so forth. There's no doubt about it. But what it really comes down to, it's the classic we have financial inflation, and nobody wants to talk about it. You see inflation right now with food, with housing, with clothing. All you see all the mechanics of it. You see all the inflation around us. But when it comes to financial inflation, since the money managers are so lost, I think I mentioned this to you. I'm going to give you a great example of it. There's a lady. Her name is Tangler, Nancy Tangler, and she runs a fund, and it's something Tangler and so forth. And her name is second on it. And so, about a week ago, they're interviewing her, and the fellow who's interviewing her, who is a trader himself, but he has a TV show, says at the beginning of the show, as a teaser, he says, and we're going to be talking to Nancy Tangler because Nancy is one of the best performers last year in the market. And I'm thinking to myself, wow, what did she do? 20, 25, 30%? I'm thinking something like that. To me, that would be compared to what everybody else did. I mean, you hear about all the hedge funds and everybody else losing money and underperforming, and you hear all that. I'm thinking, wow, that must be great. Commercial happens, it's over with. She comes on, okay, right at the beginning. Hey, Robin. So the next thing you know, she's talking about how great a year she has had, and how she was invested in some of these high flying, as no chase the market is saying, basically, is that don't chase the market. And I'm thinking, wow, she's probably did really great. I see her all the time. They're always asking her opinion. And he says she was up over 5.2% for the year. And I'm thinking to myself, 5.2%? And you're raving about her when the market itself was up. The S&P 500 for the year was up 13%. The NASDAQ 100 was up almost 24%. And the Dow Jones Industrial Average was up. The Dow Jones Industrial Average was up over 13%. The S&P 500 was up almost 24%, and the NASDAQ was up like 33%, right? And so I'm thinking to myself, she's up 5%, and he's raving about her from last year's performance? Are these people for real? I mean, they're not for real. None of it's for real. It's the way they act. And yesterday, oh my God, the world's coming to the end. The Dow Jones Industrial Average was down around 1.25%. 1.25%. Robin and I were on trading floors when they were down 25% in one day. 25%. Okay? It is amazing how irresponsible the financial news is in these times. And it's been that way since 2008. It got out of control. Mr. Obama, at the end of Mr. Bush's term, I mean, they have quantitative easing. They don't even talk about quantitative easing. At times they call it, what is it? QT, quantitative tightening. They'll call it QT. They don't even use the words quantitative tightening. They just call it QT. Or inflation is sticky. How about inflation is putting people in a bad position? They can't afford food and clothing and oil and housing. I mean, they use all these funny little words and all these funny little expressions to hide the facts. And so, I shake my head at all of it. And then it turns into a cheering section. Yesterday oh my God, the world's coming to an end. It's like it's down 1.25%. Wait till you see 6 and 7% in a mild crash. Or they go through breakers at the New York Stock Exchange where they have to close the market for 15 minutes. I mean, they don't. I mean, I don't know. Their heads might explode. It is unreal. So I like that. Chaz or no chase the markets. I like that. That is true. And you shouldn't chase the markets. And at the same time, you should marry all in big investments with options, binary spreads. Call puts, sell calls, buy puts. You don't drive a vehicle without insurance. You don't have your life without some type of health or life insurance. Your property is usually insured on some level. If you own a house, it's insured. Everything's insured. But when it comes to financial, they don't want to talk about insurance. They just want you to shoot from the hip like a bunch of cowboys. And that's what I watch. And yesterday is another perfect example of of the shooters not sure what to do because the market said basically, as what I've been saying here, for how long have I been saying inflation's only going to get worse? There's even a potential for another increase. And here we are. The markets don't care. Because why? There's financial inflation going on right now. There's way too much money trying to buy too few companies, to the point where they even have it called the Magnificent Seven, which carried something like 85% of the market last year. 7 stocks out of 5,000 stocks in the United States carried the market. So, the level of irresponsibility, the level of unable to communicate concepts and ideas and risk. What is the number one issue in trading? Risk. You rarely ever hear it. You rarely hear anybody talk about it. They don't talk about how to insure your portfolio. They don't talk about how to protect your assets. All they talk about is what's hot. What can you get into today naked and come out with more tomorrow? And that's exactly where we are at this point in time. It's the level of irresponsibility is outrageous, just outrageous. And here, Doc and Robin, we talk about the markets in a realistic way over and over and over, trying to emphasize how important it is to understand what's going on with the markets, understanding the reality. You can see we have an 85-90% accuracy rate around here, and it's been that way for over a decade doing dukoscopy. Okay? Documented from recording after recording after recording. You can tune in and see what we said last week, last month, last year, and you can see how accurate we were. And that is the real level of responsibility in the financial markets. And then we just show you our success of being able to read the direction of individual products. And so we look at the intraday, we look at the daily, we look at the weekly, and try to basically bring a level of responsibility to to investing and trading, be it intraday trading or long-term, week after week after week after month after month after year. When you marry, there's no doubt that 85% is a very, very high success rate. There's no doubt about that. Okay, and we've had it for so long, decades, that I don't take it that I don't abuse it. Let's put it that way. And I can do just as many stupid things as anybody else at a given time. There's no doubt about that. But I don't. But I can try. I can try too. Like, stepping in and trying to catch a fallen knife. We catch it pretty well. But the thing is that more than anything else is that the level of taking the market serious and putting capital in long-term direction versus short-term direction, is very, very important. Understanding why, we used to say on the trading floor, what gets you in gets you out. And so a lot of times we've talked about it here where people try to invest, they try, or trade, or whatever you want to call it. They try to get involved in a position, and they've convinced themselves that this is the way it's going to go. And then when it goes in the wrong direction, they make up a new story in their head instead of following what they've studied or practiced or researched. And that's why we used to say it on the trading floor, is what gets you into a trade gets you out of the trade. If you said an hour ago that you're getting long because you believe it's going to go up into this area here, and I'm going to be in there for 5-10 days or 2 weeks or 3 months or whatever, and then all of a sudden it goes in the wrong direction, and now all of a sudden you're losing your confidence, and then all of a sudden you go, okay, I think I'll just add more money to it, and then you lose more money over a couple hours, and you start thinking to yourself, oh, I'm going to get out. Instead of, when you start to get in trouble, you marry an option position to the long or the short, and then you wait it out. And then all that homework you did is usually much more important again. In other words, it comes through. How many times have people said, oh, I bought it and then it went down, and then I bought more and it went down, and then I gave up, and then the next day they go, oh, look at it, it's up. I should have stayed with that position. It's because you didn't use the right investment tool. You didn't use the right way of protecting your risk and allowing yourself to be invested for the 2 or 3 months or 2 or 3 weeks or whatever time period. So whatever gets you into a trade should get you out of a trade. And we're going to give you an example of that right now. We're going to go over to the short term. All right, we're going to go take a look at, let's see, did I turn it on? Let's turn it on here. And as you can see on the screen, we have the dollar index trading much more firmer than most people want to see. They are looking for that weak dollar. We think the dollar is overvalued. But again, if they're not going to cut rates, there's no reason to try to sell the thing. Just stand it aside, or trade it short term, or do whatever you want to do. But our math, let's just first show you that. Let me open up our example. We're going to open up the example of a way, what we're talking about. But first, as it's opening up on that other screen, we're going to take a look at the dollar index for just a minute here. As you can see here, it's in a buy. It's there's J4X. You can see it's been going up. A lot of green more than anything else. You can see that the fast stochastic has been beating the slow stochastic. And then we go and take a look at it on a weekly basis right here on just J4X. That's it, just J4X. And then you'll see it on our beta platform, and we'll go to our main platform, and then we'll give you the example of what we're talking about, what gets you in, gets you out. And that's going to be the title today of the webinar. Actually, I'm going to put that on the message system. That is going to be the title. And that what gets you in the market gets you out. And I think that is a good example of today's conversation. All right, so there you go. You can see the weekly. Where's the algorithms there underneath? There's the two stochastics. You can see the fast is at 91.9 and the slow is at 90. Now, when that's like that, when the fast is above the slow in price, numbers there, because we just leave them both at there. Sometimes the top is below the slow, and that means it's a bear move, long as the hinky-ashkies are green. Or in this case, if it's going up, it's green. If it's going down, it's red, okay? And when you put the two together, it gives you a good general idea of direction. That's a good example of what gets you in, gets you out, okay? So in other words, you've been doing a particular algorithm or statistic or indicator, and you've back tested it and you've analyzed it, and you see that these characteristics are indicative. In other words, they're going to be consistent. So what you do is you go, okay, I'm going to build a long position. Then you have to say to yourself, how are you going to build that long position? Are you just going to buy euros and sell dollars? That could be a way. Are you going to buy the futures contract, in this case here? Would you buy the dollar index? Possibly. Okay. And then what you do is you look at the amount of capital that you have and you're using and how much you want to risk. And you look at the general range of the weeks, how much it goes up, how much it goes down, and can you afford to let it get down to a point where it hurts, and then when it turns back up, you're okay, that type of thing. And obviously, if it doesn't, then you take the hit and you switch directions to when your statistics, your indicators tell you. Okay. So you have that like that. That's basically what gets you in and gets you out of a market. That it's the tools that you've been watching, the tools that you've developed, the tools that you've been studying. They get you in when it goes statistically in one direction, and when it goes into statistically in another direction, it gets you out. And that's pretty much it. It's not that much more complicated than that. All right. Now we're going to go like this. We're going to jump over to, and I could do this too. I could delay it a little bit here and go, here's the beta. The beta's been doing the same thing. You can see the beta's been in a weekly buy for a while. So you should obviously be playing the long side. And we look at it and we go, okay, well, when it's in a daily buy and a weekly buy, when the two are together, you can safely be long, 8.5 out of 10 times right. That type of thing. And that's getting in, what what gets you in gets you out. Okay, that's literally what it is. Nothing more than that. Now we'll go and we'll show you even more intensely of the same concept. Now, right there is the S&P 500. We can look at that. We can take a look at the euro. We can do anything. Let's go to the euro since we're really starting off as a currency webinar here. And you can see here we're going to put a line in there and show you where our indicator. Let's fix it like this, and we'll use it as a big white line, that type of thing. Extend it like that. And so in this case here, when it went into a buy right there, because both of these were through the zero line, we generally know that there's going to be upwardly strength. And as long as it stays above it, right here, as you can see, you're in a long. That's what got you in. And then obviously as it's making money, in the beginning you bought it on the close of that bar, and it instantly started to lose money, especially these last two bars, the first two bars. But notice that the math itself told you to be long. And sure enough, it goes up and starts to make money, and you decide when you're going to get out, where you're going to put your stops, and so forth. And that's the level of responsibility of trading. That's what gets you in, gets you out. And then you can see here, it goes to right there and goes into a short, and you're out, or you're short now. And then it goes back into the buy, right, where is it? Right here. There's where it goes into a buy again. So now you see it went in the wrong direction, and basically you were short from here. Let's put the sideways line in there too, like that. So you're short from there, and it gave you a chance to get some money out of it. And then, and so let's see, just move this over again like so, right there. So got you short there. You had a chance to buy some. You could have put a stop in here. You didn't. And it's still in the short all the way to, let's grab it again. It's in the short to right there. And then it goes into the buy right there. And then obviously you take your hit if you didn't take a profit here or you didn't put a stop in there. And then it goes into a buy right there. And it does, it rides the upside until right there. And we can take that and just flip that, take this and just flip it around. I think we can take this and flip it around. There we are. And so where it went into the buy right there, it found a way to go up. And again, if you put the stop in and so forth on intraday trading, when you're using only when you have only a little capital to trade with, that's the name of the game. Now, I'm not going to try to tote how good our math is, because you can always see it live. This is live. This is not, this is not, yesterday's news. Let's put it that way. You're watching it live, watching the same math, and we'll grab this again right there, and it went short there, and you can see, let's just move it over right there. Oop. So you can see here it went into the short there. It gave you a little chance to get some money out of it, and then at the same time it's been staying in the short all the way to right here. Finally went into the buy right there. So we can move that line over, and that's the example of what gets you in gets you out. You could sit there and watch the intraday tick thing going. That's where it got long here. It's long at the moment. And we'll see what goes on with that. But that is the concept of what gets you in gets you out. Okay, and now it could be intraday trading. It could be daily trading. It could be weekly trading, monthly. But what you want to do is you want whatever got you into a trade should get you out of it. The same technical system. In other words, don't invent a new system in the middle of a trade. A lot of people, that's how they get hurt. They try to talk themselves into the position that they put on, and deny and accept the tools that they were using to get into that trade. They don't use them to get out. And that's the perfect example of it all right there. So today's webinar pretty much is a simplistic concept of good, disciplined trading. What gets you in, gets you out. And that's basically the gist of it all. If you have any questions, I'm glad to answer them. If I don't know them, Robin knows them. We've both been in the markets for almost 50 years each. We have, as Robin likes to say, and I like to say, we have almost 100 years of experience between the two of us. And that is fascinating in its own right. So, that's where we are on that one. And that's a real important thing too, because people have a bad habit of getting panicky, don't stay with their discipline, and I like, no chase the market. I like that. That's exactly the way it should be. Never chase a market. Use the tools that you've got, and figure out. Look at that. That's a real dead buy, isn't it? It's just sitting there now. It gave you a small chance to get out of a couple ticks. It has threatened you for a few ticks, and it's still in the long. So we're watching it. You can see it there. It's actually moving kind of slow at the moment, isn't it? And that is the euro, right? Yeah, that's the euro against the dollar. And I guess you could say it's in a down market too. We can put that up on the screen here. They're putting a little pressure on the euro without a doubt, with like everything else, because we've been screaming it from the rooftops. They're not going to cut 7 times. What an insanity that was. Yeah, it's just been pressing down. Now this is the weekly. When we go and look at it on a daily basis, right there, you see the pressure's on. And if you really want to get aggressive with it, you can go into J4X and you can put in like you can change the tick to the same tick we do, or you can go in and use like a 5-minute bar, and you're going to see the same situation. You're going to see some pressure on it following our tools. You can see here it's turned up, and it's in a buy, and it's moving up over the last 7-8 minutes, something like that. And here our work is turned up here, 3 bars back, and you can see here over the last 10-minute period. I wonder if I could change. There you go. It's still trying to tick up. Let's see. 85%. Do you recommend using the DXY when trading the NQ? No. The NQ is the Tech 100. Wait a minute. DXY. DXY is the dollar futures contract, and the NQ is the Tech 100. They're one is a currency index. The other one is the NASDAQ 100, which is kind of like the leader of the I guess you could say the industrial nations today. Industrial stock. The stock market itself. So NQ is the Tech 100, and I've recognized the correlation has been off quite a bit for a while. Any tips? Well, yeah, one is a stock index, which is one of the smaller markets in the world. Stocks are a much smaller market, and the currencies are the second biggest market in the world. And so there are times where buying stocks goes along with currencies, and sometimes it doesn't. So yes, I think you should. That is, there's a concept called pairs trade. Okay. And pairs trade is when you, let's say in the United States, let's say you like automobile manufacturers. And so, but you think that Ford is going to outperform General Motors. So what you do is you buy Ford for the same dollar amount. So in other words, the stocks are not the same price, but you buy just as much, like you say, you buy $1,000 worth of Ford, and you buy $1,000 worth of General Motors, and they call that a pairs trade. Okay, that's not a good way of buying an automobile manufacturers as much as it looks like it's hedged. No, when you want to trade currencies, you should trade currencies. For a couple months, the Swiss was the best. When you didn't like the dollar, you bought the Swiss, and definitely the Swiss was outperforming all the other currencies. Some logic would say is just buy the dollar index itself. and that would be the best way to do it, and not try to do an offset of another product that you think has a correlation, because that can really cook you. Does that make sense, NC? No chase the market. As you can see there, our buy signal was a good buy signal, and it's climbing up. And that's that. If you were going to buy the dollar, odds are you should sell like the euro or something like that short, and buy the dollar, or the British. See, right now it seems like the British pound is the strongest of the major currencies at the moment. Let's see. Oh yeah, that's cool. I'm glad you enjoyed that. Yes, sir. I like that. I am a newbie. How many chances do I have to gain a profit? Well, I guess it depends on how much capital you're using and the way you are going to trade. In other words, are you using options, listed options with underlining cash? Or the underlining cash is basically, let's say you're trading pairs trades. So when you're trading pairs trades, it comes down to not overdoing it, so that you have, let's say you have $200, okay, and you're trying to trade with $200. Well, then you shouldn't risk more than, say, $20, and that's not changing the width of what you're trading, the direction you're trying to trade. It comes down to the amount of money you're using, the size of what you buy. So in other words, you buy very small, and you should be able to make a profit, even using like the J4X system that we have up on the screen. But you have to, in other words, you may, with $200 in your account, you may only risk, say, $15, something like that, $10, and slowly build it. As it gets bigger, then you can try to expand it. You get up to $500, then maybe you only risk $25. And you trade for $10 or $15, that type of something like that. Take a $10 profit, take a $15 loss, that type of thing. Or almost at equal, that type of thing, where you trade that way. So in other words, it comes down to how you trade. The vehicle that you use. Is it the pairs trade? And if it is, how much capital are you using? You don't risk $200 on a trade when you only have $200. If you want to be profitable, you risk $15 or $10. And this way you slowly grow. And as time goes on, your discipline builds, then you increase your size. But you're not, if you have $1,000 in there after a few months or a month, you don't go and risk $900 all of a sudden. You go risk something like $50. Or $60, that type of thing. You keep on building very small, and then let your capital base grow, and then obviously you gain more each month by following the rules that you've been using and being disciplined. Does that make sense? You're a New York resident. When attempting to sign up with Forex, I am denied any tips. Okay, yeah, well, no chase the market. I see what you're saying. I guess they allow Canadians, but they don't. I guess you'll have to, unfortunately, find another vehicle, another broker, to be able to do that. But doesn't stop you from watching Dukascopy. And then when the laws finally change around here, where Americans can use Dukascopy, you're able to use Dukascopy. And I agree with you there. I'm disappointed at times too where I can't use Dukascopy. But they allow me to talk about the market, and they don't stop me. They don't interfere. So I mean, if you in the United States, since you're from America, you know that if you say something that's not exactly in analogous or equal with the government policies, they don't want you. They don't want to hear from you. They want to stop you. There's only one way. It's their way. The First Amendment is pretty much been thrown away. It's very politically, financial. They defend everything. Democrats defend it all. They will not allow anything to interfere. That's just the way they are. So, as we take a sip of our tea there. What else can we say? What we do is we will show you different products, and you can see here that the long is still on when it comes to the euro. And like I said, we talk about live stuff here and real stuff, and what we see and what we understand over the last 45, 50 years. And not a lot of places can do that or will do that. That's the amazing thing. All right, from there, where do we go from there? Let's jump over to the cable. See what the cable's up to this morning. You know what? Let's leave that 5 minute in there and put the cable in. There's the cable. Cable's doing the same thing on a short-term basis. It's in a buy now for 3 bars. 2, 3, yeah. And so the fast was at 14.5. No, it was at 40. That's it. 40.57, and the slow at the same time was at 24. So it went into the buy with the green and told you could be long in there on a 5 minute. Now I'm not telling you I use the 5 minute on Dukascopy, so you should use it. I use what I refer to as I use spatial bars, and so it would be a tick bar I would pay attention to, not a 5 minute. We have to find out how to change that tick bar. See right there, they show that we can see ticks right there, but 3 tick is way too short. We need to be able to change that. Let's see if we can find a way. And I guess if we go ticks Alt 1, let's try Alt 1. Is that right? Alt and 1. Does that allow us to change it? We want to be, in this case here, on cable. Let's put cable up on the screen on our beta. Not beta, up on our main platform there. We use 96, and you can see the thing went into a buy right here. Let's put the line in for that now. Right there, it went into the buy right there. Let's just make it white so you can see it. There's where it went into the buy, and it's still climbing at this moment in time. There we are. And so it's still in the buy there. Now, we use 96 ticks. So I'd like to be able to alter that, but I don't know how to alter that. Maybe that way? I don't know. Let's see if we can do this and get not a line bar. I am. Let's see. I don't know how to adjust it. If anybody at Dukascopy knows how to adjust it, that would be great if we could make a 96 tick instead of a 3 tick. And there it is right there. That's a 3 tick, I guess. And so you see it's going up from 25. I've used the J4X a lot and won a lot of contests with it, on live trading, but I don't know how to adjust the tick itself because I was using a spatial. I'm trying to remember how I changed it. I was using spatial bars, and spatial bars are better because it has a better reference of time. The fixed times are 1 minute, 5 minute, so forth, and any minute is wrong because it doesn't represent volatility, and whereas ticks represent volatility at the same time. So you're incorporating a time function into volatility. Okay, yeah, sure. That's no problem at all. Do you mind going into indicators again for entry and exit? So in other words, on, let's use that on a daily basis. Well, you know what? We can use it for either of them. Here's the fast stochastic right here, the blue, dark blue, purplish, whatever you want to call it. This is the slow stochastic. Okay. When the blue is outperforming the slow or the yellow, and we have a green hinky ASCII, it's a long, and vice versa. When the fast, in that case there, was at 75.83, and then we go down to here, and it's at 80.4 or 399, and a red hinky ASCII, it tells you to be short. And obviously it works. This is in a 3 tick. That's pretty wild, but it's that's pretty cool at the same time. It shows the accuracy of it. Matter of fact, we might as well make it bigger. And that's how we play that. So in other words, in this case here, this, I guess it would be right there, and we were green, I guess, right there at, what's that, 1509, 51? So at 1509.53, I guess it is, right? 1509.53. Okay, it was at, where was it at? It was right at 12.5. See that at the bottom? Fast D was at 12.5, and at the same time, the slow is at 19. So you don't take it. You wait for the fast. In this case here, the fast goes to 41.6. Okay, and here it's at 22. All right, so now this has gone higher than this, and at the same time we have a green hinky ASCII bar, and there's your long right there, and you can see it goes up in value, and vice versa. When it does the reverse, you wait. So you always wait for, if you're getting short, you wait for the fast to go lower than the slow. So right there, is it at 85? Right there, it's at 91. You're waiting still. Next one, it's at 75. And you jump over to here, it's at 86. So now it's telling you you can be short long as the hinky bar here is red. Now, when you say, do you mind going over the indicator again? That's the indicator. Now, entry and exit. All right. Now, when you're deciding entry and exit, those 3 tools are going to give you that. All right. But. At the same time, you have to be looking at how much money you're using, how much money you have. So, in other words, if you have just $200 in your account, you're not going to be making a trade that you could lose $200 in a matter of seconds. You want to trade enormously smaller. You want to trade about 15% of your equity. The most ever you want to get is into the 25-30% area of your equity of risk. I mean, even then, that's too big, because you really need to grow. It's one thing if you have $10,000 in the account and you're risking, 20% of it. You're talking about $2,000 in a trade. That's a lot to lose $2,000. You better have been consistent so much that you keep on growing that 10,000 up and up and up to risk 2,000. You really want to risk even less, much less. 1,500, something like that. It's a lot of money to risk, percentage-wise. That's why money managers might have enormous amounts of money still parked in bonds and so forth and trying to preserve, and they're raving about people who made 5% for the year when the market's up 30%, because they're trying to preserve equity. The idea is to make something versus losing. Does that make sense? No, Chase? Looks like we're going to go into the cell there on the cable. Let's just throw that up there. I'll wait for No Chase's opinion. Look at that. Ooh, I hear a ding. Let's see who the ding is. Ding-a-ling-a-ling. Just a little ding-a-ling. Let's see. Space weather. There we go. go. So that's the answer to that one. Let's see. Space weather. Let's see who space weather. Some space weather is going. Hello, 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 space weather.
Yo.
I am in the middle of a webinar, and I'll be done in another 10 minutes. I can ring you back. How you been?
I'm wonderful, thank God. And tell the wonderful people on the interwebs that I said hello.
They're hearing you right now.
Hey, you guys are all beautiful. This guy's too smart. I can't wait to have his time again.
The check is in the mail.
All right.
I'll ring you back in a little bit. Bye-bye. All right, so that's one of my science side of things. I do a lot of different things. Okay, good. That's right. No Chase. I like that. Let's see. Chase says, do you mind going? Okay, awesome. I tried micros with a 50,000 prop account. Okay. Yes, sir, it does. Very informative from time here. Okay, now let me just show you one thing. I'm going to show you one thing. If you want to talk to us, since you're in America, let me show you how you can get to us like that. And there it is. That's who we are. We're Chicago Quant Technologies. And I think our number's there. I think you can see it right there. And you can give Robin a call. And if you want more information. And Dukascopy is a great, platform, a great place to talk about markets. We do that here. And we're always glad to, talk to some of the traders on the side. We have no problem at all with it. And maybe we can help you out and get you even into a better position. You use multiple sources. The key is always to use multiple sources, and if you can use Dukascopy as a broker, it's wonderful. But for us in America, it makes it very hard to use Dukascopy. At one point we were allowed to, then it fell apart. I don't know. The laws. Americans can't use German brokers either. Can't use that. Something about the accounting which makes no sense, because the financial accounting in Europe is so much better than the financial accounting in America, and but the Securities Exchange Commission doesn't accept that. So you can give Robin a call if you want to talk about markets more and understand what's going on. And that's the little advertisement there for us. There we go. We'll go back to where was it? Oh, that's right. Let's go back to. There's the dollar index. All right. What else do we got going on? Oh, did they go? Oh, went into a sell. Yes. Looks like the cable on an intraday basis went into a sell right there. Let's show it to you, and went totally the wrong way. We're never afraid of, and it's still in a sell, and now it's back down to where it's at. And so obviously, depending on the amount of capital that you're using, you might have been stopped out, or you're holding on, waiting, and so forth, since you just had a nice profit here from all the way up to there. And now we're back into, it's moving into that favorable position again for you financially. And that's how we go around here. We're very realistic. We use the tools that we have. We're not afraid to make mistakes, because we win more than we lose. And we've got enough experience that we have enough brains to know when to not be there. Trust me, I've been tangled with people that just refuse to listen, no matter what, over the decades. As much as I show them this is the accurate way, they somehow or another think that they can fade us, because of the high success rate. They keep on. I remember one time I was working with a hedge fund for a couple of years. And they would be like, you got a hot hand. It's like, okay, yeah, but and they would say, that was a great trade. I go, you're wasting your time. Don't tell me over and over how good I am, and don't fade me. And some of them pay attention to me and make a lot of money. And some of them after a while go, well, he can't be that good forever, and they start to fade me and do the opposite things. And I just sit there and I go, I'm not going to fight with you. If you don't listen to me to begin with, then there's no reason to me to debate it with you. And then they get cooked, and then they try to blame me, and and it's like, no, I told you, don't fade our mathematics. Be logical, consistent, and you'll do fine. And when you think that you're going to try to fade us, we're too consistent. We know when we're wrong, and we accept it. Like right there, I showed you. We were wrong. But depending on how you set your stop up and what you're doing, right now you're in the winner seat again. You can cover it right there and start over on the next trade, or hold on to the trade and see how it goes. And since if you've played the long side on the last trade, obviously you have plenty of room to not go into the minus with your stop. All right, what else do we got to say here, traders? We didn't really get a chance to look at the universe through our eyes or our mathematics. So what I'm going to do, since this is also being recorded, is I'm going to give you a quick flavor. You can use your Dukascopy platform and look at what we do. But right now, let's just give you a quick flavor of what's going on with the marketplace in general. We're going to go through the rest of the currencies right there. And that is the euro. You can see we are in a weekly sell and a daily sell. And let's get rid of that. Yesterday it was trying to get into a buy, but it closed in that line when I put in there shows you underneath the zero line, and it's in a sell for the last 3 days now. There's the cable. Cable has been in a sell for 2 days, and it's in a weekly sell for 3 weeks. Over here, the Swiss in a daily buy for 4, 5, 6, 7, 8, 9 days now. And on a daily basis, that's what the center one is. The weekly algorithm has been in a weekly buy for 4 weeks. Over there. And you'll be able to go back to the recording and see this whole expression here. The dollar yen in a daily buy for 5 days right there. And at the same time, we are looking at the weekly, which has been in a weekly buy for 3, 4, 5 full weeks. And you can see the direction has been in the correct. It doesn't go straight. It just goes, it's the way it is. The great experiment, there it is right there. It's been in a daily sell for, I guess it went into a daily buy 1 day and it went back into the daily sell for 2 days now. This is the Euro-Turkish Lira pairs trade. And the weekly has been in a buy for something like 18 or 20 weeks. All the way back in, right there in September. So you can see the trend has been up, and it's starting to flirt with a weekly sell. Then the last currency we look at is the South African Rand for the metals complex. And you can see there it's been in a weekly buy for 5 weeks and a daily buy for basically 2 weeks now. It's been in that daily buy, and you see it's been going up. Over in the metals complex, we're going to hit you with, let's do this, let's close that. Bingo, bango, bongo, because we're doing a run and gun here. That's an intraday of the S&P 500 at the moment. Let's just jump over to the dailies. And right there, there's the S&P 500. It went into the sell yesterday. It's trying to climb up. No doubt it's moving up. We've been in that weekly buy forever, 15 weeks or something like that. 16 weeks, something like that, since first week of November, last week of October. And we were in daily buys, and now we're in a daily sell. So it's a neutral position to us. And then from there is, let's see, where do we go? We go to the metal. So there is gold. Gold has been in a daily sell now for almost 2 weeks, and a weekly sell for, 1, 2, 3, 4, 5 weeks. Silver. Silver's been a little bit more jumbly, but, it does its job. It's been in a weekly sell again for 5 weeks. And a daily sell just from yesterday. It wasn't a daily buy for 3 days there. Let's see, what else can we talk about here before we get out of here? Because it's past my time to go. Let's see. Let's go take a look at crude oil. There's crude oil, West Texas Intermediate. You can see it's been in a daily buy for 7 days. From there, been in a weekly buy for 1 week, and it's flirting with the daily sell again, so it's pushed you into a neutral situation where you're kind of like not sure what to do. If you use options, you can do a little bit more aggressive trading. If you don't use options and you're naked shooting from the hip, then it makes it tougher, and you really don't want it to be sitting in a weekly sell. And it's not there confirmed yet, but it's very close to it, and a weekly buy it's in, but the problem is that it's trying to correct there. So all right, traders, that's it. We're going to be here same time, same channel tomorrow. So this is Doc from North America saying, happy trails to you until we meet again. Happy trails to you, to all our trading friends. Later, later, traders. It's been a wonderful day, and catch you tomorrow. So, and thank you, Serge. Thank you very much. Thank you, No Chase. And we'll catch you tomorrow. Same time, same channel. Ta-ta for now.